This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer. We welcome you to the Rocket City Retirement Show today with my friend, certified financial planner Cris Wallace. He's president of WG Financial Group, and also joining us from the firm are financial advisor Graham Bauer and certified financial planner Richard Constantine, all here today to give us all helpful advice about retirement planning. We all have questions. Here's the way to reach out to Cris, and it's complimentary. 256-937-2010. Okay. Now here's the deal. You may call or you can text the word visit if you like to text. I like to text. 256-937-2010. Remember, it's a complimentary discovery session. Check us out on Facebook. Just search for WG Financial Group 256. Our motto is plan, retire, and play. Find us online anytime at WGFinancialGroup.com. One other thing, our show is also available on Spotify and Apple Podcasts. Just search for the Rocket City Retirement Show. So hello to all of you.
Hello, Luann. How are you?
I'm doing great.
Luann, it's great to hear you again.
Thank you, Graham.
Hey, it's good to be back.
Okay, so let's get into this. We always start with our current events, or current market situations, I guess I should say. So I'm gonna throw this one to you, Richard.
Yeah, absolutely. So, Luann, in the past 1 month, the NASDAQ is up 5.2%, with the S&P 500 being up 2.8%. So far, year to date, the NASDAQ is up 14.53%. The S&P 500 is up 12.39%. Dow Jones is up only 3.13%, and the aggregate bond index is down 1.36%. A few other noteworthy items that happened in the past week was, one, NVIDIA has officially overtaken Apple as the second most valuable company in the world behind Microsoft. It's going to be interesting to see what the final kind of pricing of Apple and NVIDIA will be, because both are major players in all of the market indices, both on the S&P 500 side and the NASDAQ side of things. And when these ETFs and mutual funds, when they start doing their rebalancing to reflect the new market capital, the market values of these companies, they're going to be buying and selling shares. So it'll be interesting to see how this all shakes out. Another interesting fact about NVIDIA that happened on Monday, they completed their 10-to-1 stock split. So if you logged into your brokerage accounts or your IRAs and you realized that NVIDIA's price had fallen from over $1,000 to just over $100, NVIDIA did not go down 90%. You actually received extra shares for every share that you had. And Cris, I got a question for you.
Sure.
What is the only Magnificent Seven company to have never splitted now? And for our listeners, the Magnificent Seven are Apple, Microsoft, NVIDIA, Tesla, Facebook, and Facebook-Meta, and Netflix.
Boy, you're calling me out on the air big time. I'm going to say Tesla.
Graham?
Is it Amazon?
No, the only
No,
one.
you're right, Amazon split.
Yeah.
The only one is Facebook or Meta. So with Meta approaching about $500 a share, it is primed for a split here in the future.
Yeah. Thanks for making me feel dumb. Appreciate that.
Hey, that's okay. I mean, we don't preach picking stocks, so you're good.
That's right.
You're good.
Yeah, that's right.
Well, last week on our show, we covered the I in the Rite Retirement process. Let me kind of back up. Cris, his process is the Rite Retirement process. And what it is it's something that he takes you through. And Rite, the word Rite is an acronym. And I always tease Cris, he spells it the wrong way. But there's a purpose. There's a method to his madness. The R is for retirement income. And then the I in the acronym Rite is investments. And that's what we talked about last week. Well, now we're going to move on to the T in the word Rite Retirement process. And that T stands for taxes. So today we're going to dive more into taxes in retirement and what you need to be doing to be more efficient with your money so you can reduce that partnership with the IRS. That is our goal. At the end of 2025, we know, we've heard this time and time again, the Tax Cuts and Jobs Act expires. Chris, what does this mean for most Americans?
Well, it means that taxes are going to go up for most Americans. And really, before we dive deep into this, I do want to kind of say that, throughout the show, we're going to talk a lot about taxes and tax planning. We're not CPAs on staff. We do not do taxes. But as investment advisors, what we do take a look at is the efficiency of your investment tax planning. So we're going to talk today about Roth conversions and such. That creates a taxable event. We always advise people to seek the advice of a CPA or a tax professional once we've kind of established a roadmap of how we would like to take the planning. So again, just want to make sure that's like super clear. But to answer your question again, Luann, the taxes for most people are going to be going up, and several things that are changing are the marginal tax brackets. Those are going to revert back to where they were in pre-Trump or pre the Tax Cuts and Jobs Act. I should say. I don't want to get too political on the show. The standard deduction is going to go down, so it means that there's going to be more itemization. So, for example, for a married couple filing jointly today, the standard deduction in 2024 is $29,200. And when it reverts back, it'll go back to $12,700. So that'll kind of open the window up for more itemization. Whereas today, most people, I think it's 90+% at this point, are just utilizing the standard deduction. The personal exemption is changing. The child tax credit goes back. The charitable deduction is reducing to 50% of AGI. I think currently it's at 60, and then the SALT cap goes away. The state and local tax cap goes away. And here's kind of the one thing that's going to be super interesting to take a look at is the estate tax reduction. It's going to drop back to a projected $7 million. It's currently for a married couple today at $26 million, and for single individuals at $13 million roughly. So it's a substantial drop there. I have to wonder, where, what do I think is going to happen here? I don't know, but this is, for me, $7 million to accumulate $7 million, at death is not a lot. 26 million, I think everybody on this radio show is perfectly fine. And even at 7, I would argue that the most of us on the show are perfectly fine today. But as you grow your net worth, through time, and you accumulate assets, your house, maybe you have a rental property, your 401k, it's not hard by today's standards to get above 7 million. And that's where the estate tax starts to kick in. So why do I mention that? I feel like that's a pretty easy place for the government to kind of pick up some extra tax dollars if they drop it down pretty low.
That makes sense. Chris, why don't you tell us, from a tax bracket standpoint, more of what is this going to look like?
Yeah. So just to give you an idea, so the 10 will remain the 10, the 12 will go to the 15. The 22 will go to the 25. The 24 goes to the 28. The 32 becomes the 33. The 35 stays the same, and the 37 goes to 39. And if we just look at the 12% bracket today, we're looking at about a 25% increase in tax. So you can see, like, as you start to think about this, like, who is it really impacting? It's really impacting middle America, which goes against the message that we always hear. It's like, oh, we want to tax the rich. But the biggest tax increases is what we would consider middle America.
Yeah. And Chris, another thing too, it's like you mentioned, it's going to hurt middle America, which is the majority of our working class. And so right now, the way the tax code is set up, most people, it is beneficial to do a Roth version of their 401k if one is offered. But going forward, because like as you mentioned, it's going from the 12 to the 15 bracket, that's essentially a 25% increase in taxes. It's going to amplify the importance of making sure that what you're doing or what you're choosing for a Roth or traditional 401k, that decision is going to matter a lot more.
Yeah, totally agree with you.
So is there anything then that we need to be looking at or doing right now? What would you guys say?
Well, first of all, I think everyone that is charitably inclined should consider how they're given to charity today and make sure that they're doing that in the most tax efficient way possible. Richard mentioned Roth a few minutes ago. I think Roth conversions today should be well thought out and likely considered by a lot of people. So, and maybe even a combination of charitable giving and Roth conversions to kind of offset or lower income. And if you're only on Social Security, so we've talked about this a number of times on the show, when you just have Social Security income, you're kind of in that zero bracket. You're zero federal, zero state, because Alabama doesn't tax Social Security. So if you're in that position where you just have Social Security and that's it, no other pension, you're not taking any IRA withdrawals, I think you should make a strong, put some deep thought into Roth converting. And actually, I don't even think it has to be deep thought. I think it makes the most sense at that point because you're basically in a zero bracket. And for most people, there will be a window of dollars that you can pull out without any federal tax obligation. So again, if you just have Social Security income, I think it makes a lot of sense to start thinking about Roth converting, because at that point you're just in a zero to very, very low tax bracket.
And, Chris, on the Roth conversion side of things, like you were mentioning, that has definitely been a conversation with a lot of people, especially, the higher net worth individual in these next couple of years. There was actually a couple clients in the office probably just a few days ago that I was having a conversation about Roth conversions with. And it's a funny conversation to talk to people about, because from strictly the data side of things, essentially we have this tax year and next tax year. Then after that, we don't really know exactly what's going to happen. Maybe we'll be back in the old brackets. Maybe some kind of new legislation will be passed, but we obviously don't have the information of that yet. So, we laid out kind of a plan of what we could do to, save a pretty significant chunk of taxes over the course of a few years, mainly in the next couple of years in these more favorable brackets. But the mental side of it, I think, was just a little bit too much to get over, because in this plan that, I'd kind of created for them, it was going to be 6-figure plus tax bills for a couple of years. And even though that had the potential, depending on what happens with the brackets, to save them a lot of money over time, that's a lot to write today. So we actually kind of ended up scaling it back a little bit because, kind of in our eyes, it was doing something was better than doing nothing, because they were just like, yeah, I don't know that we can mentally stomach paying that much in taxes up front, which I think is a common feeling, but it kind of gets into the data versus the mental side of things. Sometimes there's, maybe the technical right way to do something from a numbers perspective, but you also have to feel comfortable doing it. And when you're retired, sometimes paying out those massive chunks of your retirement saving in taxes early on just doesn't feel very good.
No, you're right. What you're mentioning there is that whole mental aspect of swallowing that tax pill today. I mean, it's a difficult pill to swallow for some people. Even if the tax amount's low, let's just say it's $25,000. There's a lot of people that we would sit down with and they don't want to pay the $25,000 today, even though the forward looking, assuming that rates do go up, the savings is still there, but swallowing that tax pill today is just very, very difficult for a lot of people. And it's a major mental hurdle that I think they have to get over.
Well, and Chris, you mentioned this earlier too on the show about how the estate tax limits are going to revert back to a smaller level. Now is the time where part of our job is to project out what our clients' net worths are going to be at when they do eventually pass away. And so now is the optimal time to start getting a plan in place if our clients want to do it so that their beneficiaries receive a higher amount and we're not giving as much away to Uncle Sam.
And what we always talk about is get a plan in place now so that you aren't making emotional decisions, at a certain time in your retirement. So the time is now. And here's the phone number, 256-937-2010. That is the way that you can reach out to Chris for a complimentary discovery session, 256-937-2010. You may call, you may text the word visit if you want to do it that way. You can go to the website, wgfinancialgroup.com, and fill out a meeting request form there. Okay, so great information that these guys at WG Financial Group are giving you today, and make sure that you act now, because you may as well. Things are going to be changing here in a couple of years, and you need to be taking advantage of some of these things you could be doing in your own retirement plan. We thank you so much for joining us. This is the Rocket City Retirement Show. I'm Lou Ann Fulmer here with Cris Wallace, Graham Bauer, and Richard Constantine of WG Financial Group. All right, so we have talked about this numerous times on our show, but I want to go through it again. Go over the difference, Cris, between tax preparation and tax planning.
Well, obviously, tax preparation is basically just doing the return. And that's what I think the majority of what happens out there today, whether you go to the local tax place that, is on every corner during tax season, or you go to your CPA or tax accountant, they're pretty much just prepping the return. It's been my experience, and this is not a knock on, any tax person, especially CPAs. They're incredibly smart. The exam to pass for the CPA designation is really brutal. So when I say this, it's definitely not a negative comment. But what I have seen and the feedback that I've received is most CPAs and tax accountants, they really don't offer that tax planning. So they'll do the taxes, and then at that point, it's all a historical discussion. You've done your return, and it's all based on stuff that's already happened, and you can't fix any of it at that time for the most part. Tax planning is more of a forward-looking type of a plan, where you're looking at how you're contributing to your retirement plans. You're looking at whether or not you should consider an HSA. There's certain other deductions and ways that you can do some forward-looking tax planning. And that is part of what we tend to do at the office is take a look at a client's situation and see how we can help them today and then even tomorrow. And tomorrow meaning in the future. And we're talking about Roth conversions. And, maybe for some, that's an avenue that should be considered. But that's part of what tax planning is. It's more forward-looking than having to have that historical discussion about something that's already taken place.
And Cris, one thing I think a lot of us don't understand, we've got all our money saved in 401ks and IRAs. When are we mandated to take from those?
Yeah, so the laws have changed, and to this day, I still hear a lot of people talk about 70 and a half is the old RMD age, because that's what it used to be. And then the Secure Act came along, and it got pushed to 72, and then Secure Act 2.0 came along, and it was 73 and 75. So if you're born in 1960 or later, your required minimum distribution date where you have to take money out of your pre-tax retirement plans like 401ks, IRAs, is actually 75. So for a lot of people listening to the show, that leaves a lot of time to tax plan up until the point where you're actually mandated to have to pull funds out of those accounts.
Yeah, and one thing I think to note on RMDs that I've had to explain to a couple people recently. We'll have people come into the office that just have a lot of accounts. Because nowadays especially, people are working more and more jobs. And so sometimes someone will come in, they'll have a few 401ks, a couple IRAs, a SEP IRA, all these things out there where there is a lot of benefit in consolidating before you get to RMDs. So you're not having to take RMDs out of multiple different accounts if you can help it. Because, for example, if you have a few different 401ks, you're going to have to take an RMD out of each of those 401ks. Same with like a 457 plan. But, IRAs, even if they're not consolidated into one IRA, they have to be figured per IRA, but the whole distribution can be taken out of one account. And the same goes for, a 403B or the simple and SEP accounts. And one other thing about RMDs that for someone who's working a little bit longer could be a little bit beneficial to know is that, if you own less than 5% of the company you're working for and you're, still contributing to a 401k, you actually don't have to take distributions out of that 401k, even if you get to the required minimum distribution age at this point. So there's, a couple things about RMDs that can help people delay it a little bit or just make it a bit simpler, because sometimes having just all these accounts out there is going to make it maybe a bit harder to tax plan, because you're saying, oh man, I can't forget to take it out of this account and this account and this account, rather than consolidating it and just making it easier for your family.
Yeah. And, one other thing to keep keep in mind is that if it is a Roth IRA or the Roth portion of a 401k, RMDs do not apply to those balances.
Good point. Yeah, the Roth.
Yeah, and Graham, you mentioned just something I would just want to kind of reach back and touch on, the complexity of all of the different accounts. That's an excellent point, because we see people come in, and again, I said that, I think it was last week, we've heard it before. I'm diversified. I have my money with, multiple different advisors, or I have multiple different accounts. From a simplistic standpoint, it does make sense to consolidate and kind of compress things, if you will. But the aggregation, understanding the aggregation rules is really, really important. So I want to make a super clear example here. Let's say we have an IRA, we have a 401k, and let's say we have a 403b. Underneath the aggregation rules, none of those can be aggregated. So if you were taking RMDs, you would be required to take from the IRA, from the 401k, and from the 403b. You cannot aggregate those. But let's just make it really simple and say all three of those are IRAs. Then you can aggregate the IRA totals. You must figure the amounts, the RMD amounts. You must figure them individually. So you have to go and figure each of the three IRAs, and then you can aggregate and pull all of the amount from one or two, or however you choose to do it. The way that you get that number is you actually use your end of year balance on 12/31 the year prior. Now, a lot of people don't know that, but that's where you get that number from. So you would get that from your custodian, what's your end of year balance, and then you're going to use the IRS table to figure out what your required minimum distribution is. But the aggregation rule was really, really that's good mention there, Graham.
Yeah, and even the IRS tables at times are something you need to keep in mind, because if you have a spouse that's 10 or more years younger than you, you're actually going to be on a different IRS table. So you'd be using the joint life expectancy table at that point, which is, going to make your distributions a little bit less. I mean, it's not necessarily a massive difference, but it's something you need to know about to just make sure you're figuring the right amount.
I ran into this yesterday, actually, Graham. I didn't know you were going to talk about this. You weren't in my meeting, so this was like after hours. Me and Levi were doing a late meeting. And my suspicion, based on what I was reviewing yesterday, is I have a couple that's more than 10 years apart in age. And my suspicion is the wrong IRS factor was used. And so I've asked them for some more data there, because to your point, there's two different tables. You actually get a little bit of relief in terms of the amounts that have to be withdrawn if there's a larger age gap between spouses.
Very interesting, guys. Now, let's just go to this part here, because you guys are financial advisors. Does working with a CPA help?
Oh, I believe that 100%. I think that everybody should, I've said that before, have a dream team. So you need to have your tax person, CPA, your financial advisor, your estate planner. I think they all have their role in protecting a family. So absolutely, I think it's beneficial.
I think we talk about this a lot. People today think that tax planning is just for the rich, people who have a lot of money. What are your thoughts there, Chris?
I always want to laugh. I'm like, does everybody pay taxes?
Yeah.
The answer, everybody out there shaking their head, yeah, oh yeah, absolutely. Then tax planning is for everybody. I don't think it means that it's just for the rich. I think, and obviously I believe rich is a relative term. Some people say I'm not rich, and they have, I've had people come in before and they're like, oh, I've got $700,000 saved for retirement. You're rich.
Mm-hmm.
You're rich. Well, $700,000, you're rich. So I think, no matter what the amount of money is that you have either saved or that you're trying to save, I think you can use tax planning. So I'll make a couple examples here. Let's say that you're in your 20s and you're just starting out. You don't have a lot saved. You need tax planning on how to save. And you need to know, what is the best way for me to save today, and what's going to have the greatest impact today, tomorrow, and way, way down the road. So again, I think tax planning, is for everybody, Luann.
Yeah. And, I think one thing to remember there too is just taking like the Alabama state, tax rate being like 5% today. That 5%, it's 5% for everybody. But if you are, making $50,000 a year, the 5% might feel a little bit more than it's going to feel if you're making $200,000 a year. It's the same percentage, but it might sting a little bit more if you have a little bit less. So even if you don't have millions and millions saved for retirement, saving a certain percentage in taxes, even if the dollar amount looks smaller, can be sometimes maybe even more beneficial because, hey, maybe you're actually needing some of that a little bit more. So yeah, it's definitely not just for the ultra wealthy. Everybody can find ways most of the time to save a little bit on taxes and sometimes save kind of a crucial percentage that they're going to need.
Here's another story for you. 2 weeks ago, had a single widowed female come in the office. Because of the situation, they had to do some Medicaid planning. So now this particular person has income coming in from an annuity. So we know how much she needs to pay the bills. We've gone over that. But now she's got this annuity that's going to continue to pay for the next 7 years. So she has an extra like $1,700 a month coming in. And she was not maxing out her 401k. So once we came in, she was, she basically said, hey, I've got this extra money coming in. I'm just going to put it in savings. And I basically sat her down and I said, let's look at your whole plan and let's offset that income, because now you're going to be in a single filer bracket. You technically do not need the $1,700 a month. You're just going to take it. You're going to pay taxes. You're going to put it into your savings account, in which you're going to pay more taxes on the interest earned today, because most good savings accounts are probably paying somewhere between 3 and let's say 4.5% today. So I said, let's increase your 401k contributions by $1,700 a month, and let's offset that income coming in, and let's funnel it back into our 401k so that we can get you closer to maxing out this income. This is a single widowed female, income under $100,000, and she needed tax planning. So the message is, again, it's not just for the wealthy. I think when you're working with an advisor that can recognize things, it can be a tremendous asset. And for her, it was a huge help, because her taxes would have went up tremendously based on the annuity income that was coming in, because it's taxed at ordinary income tax rates.
Oh my gosh. So yeah, a tax planning, a critical part of a retirement plan. And of course, it's beneficial. And that's what Cris and the guys at WG Financial Group do for you. They help you come up with tax strategies. We're talking about the T in the Rite Retirement process. The T stands for tax planning. And Cris, I want to get into the aunts, or I should say the two sisters that you've talked about a lot of times on our show, Irma and Iris.
Mm-hmm. Yeah.
So get into those for a bit.
Yeah, absolutely. Everybody has two sisters, especially when you're north of age 65, or actually when you're 63, you start getting introduced to a sister you didn't really know you had, and she wants some of your money, and her name's Irma. And what Irma stands for is the income-related monthly adjustment amount. And what they look at is your modified adjusted gross income, and they look back 2 years. And if you make over a certain amount, your Medicare premiums are going to increase. It also impacts your Part D, but I'll give you kind of an idea here. For a married couple in 2026, if you have a modified adjusted gross income of more than $206,000, your Medicare premium goes from $174 up to $244. And this continues to escalate based on your modified adjusted gross income. So I'll give you another example. If you're greater than $386,000, your Medicare premium goes to $559, and it stays there for 2 years. If your income comes down, that's fine. They're always going to look back 2 years. So it can come back in and it can level off, but you're going to be paying that premium, that higher premium, for a period of 2 years. Now, I mentioned 386, and people out there are probably listening going, I'm never going to make that much. Well, what if you sell a house? What if you sell a piece of property? What if you have a large RMD that you have to pull? This is why we feel tax planning is super critical to everyone's retirement plan, because it helps. It makes a difference, and nobody wants to pay unnecessary taxes. It just doesn't make sense when there's a way to utilize utilize a tax code, basically, and vehicles that are available today to help you offset some of that. I think it makes complete sense. And again, we're glad everybody tuned into the Hey Luann. I hope everybody's getting some good stuff out of this. This is like drinking from a fire hose today, but I hope everybody's enjoying it. And we just want to thank everybody for joining the show today.
Don't panic in uncertain market times. Let Cris Wallace be your trusted guide. Call Cris Wallace today at 256-937-2010 for expert advice and support. That's 256-937-2010.
Wait. Now, wait a little longer. Great. You may have just increased your lifetime income by tens of thousands of dollars. That's how Social Security can work for you. The longer you wait, the more money you may get. Deciding when to start taking your Social Security benefits is one of the most important retirement decisions you'll make. Cris Wallace and the team at WG Financial Group can show you the options and help make the right decision for you and your situation. Call them today, 256-937-2010. You spent decades paying in. Optimize what comes out. Cris Wallace and the WG Financial Group team can help you squeeze every penny out of your Social Security benefits. Don't wait any longer. Call now, 256-937-2010. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm is not affiliated with the U.S. government.
Want to feel confident in your financial future? Let Cris Wallace from WG Financial be your guide. Take the first step today by visiting WGFinancialGroup.com.
I want to give you that phone number again. This is the number to call for that complimentary discovery visit, 256-937-2010. Now, you can call or text the word visit, okay, to go in and set up an appointment for that. I also want to mention, though, that you can set up your next lunch and learn, okay? If you are the owner, president, HR manager of a business, Cris would welcome the opportunity to come to your place of business and do a lunch and learn for your employees, okay? This is also complimentary. The number is 256-937-2010. Give them a call to schedule that. And we thank you so much for joining us. This is the Rocket City Retirement Show. I'm Luann Fulmer. Okay, so let's move into some case studies now. I think these are really good examples of what's happening with retirees and things that our listeners can maybe be doing today. What are some strategies that pre-retirees and even retirees could be doing today to try to reduce the amount of taxes that they're going to pay?
Yeah, so I think what we can look at here is donor advised funds. We know them in the office as DAFs, DAFs. So if you ever hear us say DAF, we're talking about donor advised funds. Gifting appreciated assets, I think, is another way that you can help offset tax liability. A lot of people don't utilize that strategy. Roth conversions is another one. QCDs, which stands for Qualified Charitable Distributions. And then we have what's known as a Charitable Remainder Trust as another opportunity. And then lastly, I'll just kind of mention tax loss harvesting during the year. I think those, when we talk about tax loss harvesting, you're basically going to take a security that you're at a loss with, and you're going to sell it for a loss to offset capital gains or to enable you to create some tax reduction there. The one thing you do have to be careful of when you're doing tax loss harvesting is there are rules where if you sell a security, there's a period of time where you cannot go back and rebuy that security. That's, say for example, you sell the S&P fund, you couldn't sell it for a loss and then turn around in 2 days and rebuy an S&P fund. There has to be about a 30-day window in between the purchases, or else you will not be able to claim that actual loss. So those are just some strategies. We'll probably go through a few of these on today's show. I think it'll help people kind of understand the different types of tools that are available out there today, and how you can utilize those in kind of reducing your taxes.
One thing I want to specifically mention on the pre-retiree side of things, because I have seen this a couple times. There are some younger people, in 20s, 30s, 40s who are making really, really, really good money. And I know that a lot of the content that we see online usually is always talking about Roth IRA, Roth 401k, which is great and should not be something that people totally stray away from. But for the pre-retiree, we have run into situations where people, I can remember one family specifically, they had to pay like a $15,000 tax bill out of pocket at the end of the year. And they came in and sat down with us. They were probably in their early 30s, and the husband made really good money. He was like probably pushing $300,000. And they were kind of like, how do we save taxes here? And he was pretty much maxing out his 401k, but it was all Roth. And so when you're getting to that point, there definitely needs to be a conversation about, yes, of course, you do want to save taxes in the future, and you don't know what's going to happen with tax brackets. So Roth is good for shielding some of that. But also, there comes a point where we do find it a little hard to believe that in retirement, you're going to be paying as high of taxes as you are today, someone making, $350,000 a year or more, because you're just such a high income earner. You're not going to have a pension when you retire. Who knows what Social Security is going to be? We think it'll be there, but it's a long time to project out. But I do think that once you get to a certain point in income, even as a younger individual, the full Roth option might not always be the best in every situation.
Yeah, I think as your income goes up, Graham, to your point here with this family making a lot of income, I think there does have to be some thought put into, am I really better off to do some in pre-tax today? And at the very least, look at an HSA. So you can get, roughly $8,000 a year into that right off the top. And then maybe look at least a combination. I mean, if you're way up in that 30 plus bracket, you do have to kind of start asking yourself, are you going to be in that 30 plus bracket in retirement? As of today, I would say that none of my clients really, I say none, I shouldn't say that. A select few are in that 30 plus bracket. Most of them are in that currently 12 and 22 bracket and maybe up into the 24. But I think you do have to think about that. And that's an excellent point there.
Oh, and also too, I mean, Graham, to your point of if a high income earner utilizing a traditional 401k option, I mean, if they are up in that bracket, it does make sense, in my opinion, to use a pre-tax vehicle instead of a Roth vehicle. Because one, you mentioned, we don't really know what the tax brackets are going to be like in the future. But on the flip side of that, though, is too, at their current rates, the amount that they're putting into the account on a post-tax level, it just gets chopped down so much on a marginal scale that, if someone's in the 35 bracket, you're putting $100 into the traditional IRA or traditional 401k, then you're only really putting in $65 into the Roth version of it. And so it just, the compounding effect, it slows, and taking advantage of a pre-tax vehicle for a high marginal tax bracket person can be ideal.
Yeah, I think also there's this big mental battle, and maybe it's fear. Maybe it's like, I've heard people say taxes are going to be 90%, 10, 15 years from now. I'm going to do everything I can to put it in, post-tax so that it's Roth and it's tax-free in the future. And that, to me, that's a big struggle that goes on inside of someone as they're trying to decide what should they really do. And at the end of the day, if you do all Roth, well, good for you. At the end, when you start taking the money, it's all going to be tax-free and you don't really have anything to worry about, but you could be potentially harming yourself today just because I don't want to call it overreacting, but maybe it is slightly overreacting.
256-937-2010. Remember, that's the number to reach out to Cris for a complimentary discovery visit. Get on their calendar, go in and see them. Text the word visit if you'd prefer to just text 256-937-2010. And remember, the website is wgfinancialgroup.com. So you mentioned a donor advised fund, or DAFs, Cris. Can you explain that a little bit in more detail and how this can be helpful to people?
Yeah, so a donor advised fund is really, first of all, you need to be charitably inclined. And a donor advised fund is set up by like a third party, and they're great for gifting either cash or appreciated assets. And what happens is you get a large deduction in the year that you make the donation. So let's say, for an example, you make a $100,000 donation to a donor advised fund. You can then use that in your taxes as a charitable deduction, and you'll get the tax deduction in the year that you actually make the donation. Now, moving forward, as you distribute money from the donor advised fund to whatever charities you're trying to give to, you don't get the tax deduction in the subsequent years. So it's only in the year that you actually make the donation. And we have found that using those in conjunction with Roth conversions actually can help lower your tax liability, especially for the charitably inclined.
This was actually something that I was talking to another client about a week or two ago, and to give people, maybe a specific example of just how this looks practically in the situation that we're looking to use it. We had a couple come in who the wife had worked for a long time for the same company and accrued a lot of company stock inside her 401k. And so we were able to do a net unrealized appreciation rollover, or NUA, for them. And while, over the long term, that's going to save them a lot of money. So essentially what we're doing there is we're rolling the stock out to a non-qualified like brokerage account. But in order to do that, you have to pay all the taxes on the cost basis. So how much you paid into the stock in the 401k in 1 year. And for them, that was, I believe, close to $70,000. So that's a lot of taxable income to add to their tax bill. Well, it kind of worked out in a way that their church, I believe, is doing some kind of building fund, or there's some sort of big giving event that's happening at their church. So they were like, well, we're already kind of considering giving a good amount of money to the church. So what we're actually able to do is help them set up a donor advised fund to pretty much offset the tax liability of the NUA rollover that we did, and have a little vehicle that they can be giving out of their church to. So, I mean, they were pretty happy to learn about that. But, the stars sort of aligned in a way. And if you're not charitable, it makes it a little bit tougher. But in this situation, it was a really, really good option for them.
Yeah. And honestly, to be really frank, had they not been working with us or with someone that's familiar with these types of strategies, they would have just written the check out of their checking account. And what they did was they turned around and they made the more efficient way to gift assets in so that they could help their church out. So again, just the value of having a financial advisor. Some people have an issue with paying financial advisors. Well, this is a great example of the value that a good financial firm can actually bring to your family.
All right. I want to dive a little deeper into, this is still on, kind of gifting. It's called gifting appreciated assets. And if you could tell us what that means, Richard.
Yeah. So, there's a lot of levels for gifting appreciated assets. One of the more complex levels is if you're a small business owner and you want to start gifting shares in your business away to your beneficiaries. So that way it doesn't apply to your estate tax. What you can do is actually put your business inside of a trust, and it captures the value as of today. And so if your business keeps growing, it actually doesn't apply to your estate tax limits. What it's going to do is it's going to minimize your estate tax in the future. So that's on a very complex level. On a more simplified level, it's a similar thought process to using a donor advised fund. What you're doing is you're gifting appreciated shares. You are not taking the tax consequence of selling that position, and you are offloading it onto either another entity or another individual to either take the tax hit if it is a person, or if it's a charity or a church, then they are not going to have to pay taxes on that appreciation.
Yeah, let me give an example here just to see if I can verbally make it visual over the air. Hopefully I said that correctly. Let's say that we have 10 shares of a specific stock. Let's say it's XYZ stock. So we bought 10 shares, 10 years ago, and we paid $100 for those 10 shares. So $10 a share. But let's say now that those 10 shares is worth $25,000. So we know that we have a $24,900 capital gain at this point, long-term capital gain. And so what we're saying here is that if you're giving to an organization such as a church or some sort of charity, in this case, in our opinion, it would make sense to gift away those shares in kind to the organization, so that you're offloading that capital gains liability that you're going to have to pay in the future. Because eventually, you're going to want to sell those shares, and when you do, you're going to be realizing capital gains either at 0, 15, or 20%. So you may want to use the gifting in-kind security strategy, especially when you're below 70.5. This is a great way to basically offload some of that capital gains. And then essentially, what you were going to do is you were going to write, and let's just keep the math really, really simple here. Let's say you were going to write the check for $25,000, and I just told you those securities are now $25,000. Well, what we would tell you to do is gift those 10 shares that are now worth $25,000 to said charity, and then take your $25,000 out of your checking account and rebuy $25,000 worth of that security. And in doing that, you've now put yourself back in a zero gain position. So you've gifted away your gain to the charity. You've taken the money out of your bank account, repurchased those securities because maybe you like those securities. That's why you've held on to them forever, and that's why they're at the value. But that's kind of, a strategy that works really, really well. And you've basically pushed off that tax liability to a charity, and then they're not going to have to pay taxes on it. But you've gotten rid of it out of your household at that point.
Yeah, and one thing I wanted to clarify to make sure that what I was talking about when you're gifting shares to an individual, if you do pass away with the appreciated stock in your account and your beneficiaries, let's say your kids, are receiving those shares of stock, they're actually going to get a complete step up in cost basis. So the cost basis or the gain goes away. The capital gain issue is only applicable if you are alive and the person you are giving it to is also alive.
The thing that I've always found a little bit funny about when talking to people about gifting appreciated stock to churches, and you cleared this up a second ago, Chris, but just to reiterate it again, the church is not going to have to pay the taxes for you. Because sometimes I think people don't necessarily want to give that way because it feels really impersonal, or they're nervous that the church is going to think I stopped giving money because I'm just giving them, shares of the S&P 500 now instead of writing a check or putting cash when the tray comes around for giving. But a lot of churches are set up with a brokerage account for this exact reason. Your church has to be set up with a brokerage account in order to do a direct transfer. Mm-hmm. But a lot of them are, we've run into a few scenarios where someone goes to a really small church or something and they haven't set it up yet. But for most churches, it's a big benefit because, it's not like the giving is any less important if you're doing it in stock, because they're just going to probably liquidate the stock pretty much immediately and get whatever dollar amount you have in there tax free. So they don't pay taxes. You don't pay taxes. It's really a win-win. But it is funny to hear people say, well, our pastor always says, we want to make sure everybody's given every Sunday. And it's like, well, we might have to project out a little bit if we do it this way, but, we're not going to scale back on giving.
Yeah, Graham, to your point about people not being comfortable, it's because it feels different. Just like when you go to take money out of the retirement plan, it feels different because you've been putting money in for, 40 years in some cases. But this is really the most efficient way to give, is do that in-kind distribution, give to a donor advised fund, and put your, offload the tax liability off yourself and put your money in just a better position long-term.
Gosh, there's so many questions I want to ask, but okay. So I'm going to go back to that Roth conversion.
Luann, there's a lot. There's a lot. This show, we may end up doing 2 shows of taxes just because there is a lot.
Right. So again, we're covering the T in Chris's process, Rite Retirement Process, RITE. So the R is for retirement income. We went over that a couple shows ago. And then investment is the I. And then now we're going over the T in the acronym Rite, taxes. Talk about how Roth conversions, and I'm kind of a fan of these. I love hearing how they are helpful in tax planning. If you could talk about that.
Well, they are helpful. And, I would say for most people out there today that converting to a Roth IRA, depending on where your situation is, financially and tax wise, I would say for the majority of people out there, a Roth conversion is actually helpful for many.
And
Luann, sorry to cut you off there, but a client that we're working with, or that I'm working with right now, he has just recently retired. He's receiving a pension from a government program here locally. We are waiting to claim Social Security, and it's not really for the growth on Social Security. The reason why we are waiting to claim it is so we can start implementing some Roth conversions. And so that's why it's important. That's another reason it's important to have someone that you trust that you can bounce ideas off of.
Right. So what you're doing, Richard, if I'm understanding you correctly, is you're, basically limiting the amount of income that's going to go on the tax return. And that's what Social Security is going to add more income, which lessens the room within the tax bracket to be able to do that Roth conversion.
That is correct, right? And we don't want Social Security being taxed at a higher rate if we can avoid it.
Okay.
Yeah. And on that note, I'll tell another quick story. I had somebody come in the office, radio listener. Here they come, and husband is still working. They started claiming the wife's Social Security at 62. And I asked why did they start? They said, well, she's 62 and she could claim it and it's kind of her money. And I said, okay, that's fine. I said, you're aware of the 30% reduction, right? Oh yeah, we're aware of that. I said, okay, well, had you come to see me beforehand, this is the way I would have told you to do it. Now you don't have to do it this way if you're listening to the show, but this is just the way my brain works. This family didn't need her Social Security. So essentially with them claiming at 62, they've reduced her benefit by 30%. They knew about that, but what they did not think about was that it was going to add income, to Richard's point a few minutes ago, to their tax return, which causes the Social Security to be taxed at a top rate of 85%. And ultimately, at the end of the day, it increased their federal tax liability by $1,500. Now, they had done this inside of 1 year. So with Social Security, you have 365 days to do it over. You just have to pay back all of the money that they paid you, and then you can kind of restart the clock. So I left it up to them on whether or not they want to do that, but they were completely unaware of the federal tax liability that they, have cost themselves. So the two things happened here. One, we stopped the growth, and between 62 and 67, let's just round it, it's about 6% a year in Social Security. So we've stopped the growth, it's guaranteed, with the delayed retirement credits. And then also now we've increased federal tax liability. So in my opinion, not a good decision, but hey, that's what some people, they want to do that. They want to get their hands on Social Security quickly, but sometimes they make a knee-jerk reaction instead of like looking at the data. This family's not going to run out of money or anything like that. It's just a little bit inefficient in the way that I would have done it.
Well, to me, Roth conversion sounds so good, but should you do all your pre-tax money, convert all of them to Roth?
Good question. This is a great question. All right. So the idea of having all of your money tax-free sounds amazing.
Yes.
I mean, sitting here today, I'm like sitting here thinking, well, shoot, if all of my money was tax-free, that would be awesome.
Right.
But there can be situations where I think it makes sense to leave some of your money in pre-tax status. And part of that is if you're going to be charitable giving north of 70.5, you can give direct from an IRA. We'll talk about QCDs in a minute. But another way is like long-term care. Maybe you keep some pre-tax money back behind you for long-term care. And the reason I say that is if you're actually paying for long-term care from an IRA, you're going to offset a lot of that withdrawal with the medical deduction, because when you itemize, let's just say you're paying $80,000 a year for skilled nursing care, you're going to itemize, and anything above 7.5% of your adjusted gross income is going to be, you're going to be able to itemize that. So you're going to have a pretty healthy medical deduction. So pulling long-term care payments, if you're self-paying from an IRA, for somebody who's self-paying, I think makes a lot of sense. And that would be just kind of one reason. I don't know that I would convert. Actually, two reasons: the QCD reasons, and then also the long-term care reasons.
Okay, well then let's talk a little bit more about QCDs then. That can be a useful way for us to give to charities.
Oh, okay. Yeah, we talked a lot about charities today, but qualified charitable distributions. When you reach the age of 70.5, you have the ability to give direct from your IRA to a 501c3. And that can also be a church in most cases, because they're usually grandfathered in under the 501c3 guidelines. But the rules are that you have to give direct from the IRA, and you can't give it like that from a 401k. So if you have money that comes to you from the IRA and it hits your checking account, and then it goes out to the charity, that's not a QCD. The QCD goes direct from the custodian to the charitable organization. So there's a process that has to happen there, but it's an incredibly efficient way to give. You can give up to $100,000 a year that way. It's a lot of money you can do. Most people don't give that much, but you can. We usually use it when people are taking required minimum distributions, and I ran across this actually just the other night, where the guy's 81, wife is 67. So there's that age differential. And Graham, this is what I was talking about, where I ran into it, where they, I don't know if they're using the right RMD table, but they're also not utilizing QCDs for his IRA, and they're given $15,000 a year, and they're in the 24% bracket. So you're talking about pretty substantial federal tax savings there, and they're just not using it appropriately. But a qualified charitable distribution, direct from the IRA, you got to be at least 70.5. Another fantastic way to give.
Okay, love it, love it. Now, you had mentioned a really useful tax tool again called a charitable remainder trust. I've not heard of that. So I need to explain what that type of tool is.
Yeah, these are pretty complex. This is basically a tax-deductible, irrevocable trust, and you got to have charitable intent here. That's got to be the main reason for doing this. And 10% of the, what goes in there has to go to charity, but you do get some tax deduction on the front side. So again, thinking of this, similar to a donor advised fund, you get a little bit of a tax deduction. The difference between the donor advised fund and the CRT is the CRT is really used for charitable intent and then income. So let me give you an example here. Let's say you have a highly appreciated stock position in a non-qualified account. You can, if you sell that, like let's go back to what we were talking about earlier. We've got that security that we bought, those securities we bought for, $100 and are now worth $25,000. So if you have substantial gain there, you might look to put that in a charitable trust. And the reason for that is you can take a little bit of a tax deduction. 2, some of it goes to charity. And then 3, you're going to get income back out of that trust. So when those securities, and it needs to be much more substantial than $25,000, by the way, I'm just using this as an example. But the securities, once inside that trust, can be sold at no tax obligation. So those appreciated assets can be sold inside the trust, again, with charitable intent, with 10% of it. And then the income coming back out of the trust, you can, you'll take that and you'll pay capital gains on that as well. There's a lot of different rules, with a charitable remainder trust. I feel like they're an excellent tool for people that have a lot of money, who are charitable minded. And I say a lot of money in non-qualified accounts. That's when I think they make really good sense. And they're going to need income, right? Because you're going to get income back out of there. The other way to utilize them, and we'll kind of start wrapping the show up here, is we know that with Secure Act 1.0, they changed the stretch IRA rules. We're all aware of that, where you used to be able to stretch an IRA out over your life expectancy, or your beneficiary could stretch it over their life expectancy. Well, now you can't do that. Now you have to pay the taxes in 10 years. And again, just as a reminder, that's Roth money as well. So if you have Roth money that's set up, you have 10 years to leave it in Roth, and then it's got to come out of Roth status. Well, with an IRA, you got to have all those taxes paid inside of 10 years. But if you use a CRT after death, there's no deductibility for you, like in those non-qualified assets I was just explaining. If you put the appreciated assets in, they can be sold and then income generated. Using a CRT after death, a charitable remainder trust after death, you can actually now stretch that IRA out up to 20 years. Now, remember, Secure Act says 10 years, right? Okay. Well, if you use a CRT appropriately, now your beneficiary can stretch that IRA money out over 20 years. Remember, you got to have charitable intent, and a minimum of 10% of that has to go to the charity. But it is another way to tax plan after your death. So we have covered a lot of stuff today. My brain actually is kind of exhausted from talking about all the different tax ways, and we just hit on some of the major ones. But these are just the types of things that we go over with clients who come into the office. We're not only looking at your accounts, your retirement situation, we're also looking at trying to help you become as tax efficient as possible. So with that, Luann, I'm going to wrap the show up. I appreciate you, Richard Graham, being here today. Appreciate all the listeners. I'll give our number out, 256-937-2010. If you would like to set up a discovery session, give us a call at 256-937-2010. I hope everybody has an awesome and blessed week, and remember to serve every situation remember to serve every person in every situation with a servant heart.
A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.